Well, hello and welcome back to IME 315. I'm going to go over the second portion of what I want to cover about accounting statements, or about accounting, which is the actual financial statements, the profit and losses statement, balance sheet, and cash flow statements. These three statements are what basically describe a company's activities, and I want to make sure that you have a rudimentary understanding of these. Profit and losses statement can sometimes be called an income statement, an earnings statement, statement of consolidated earnings. The other two statements typically go by those names, balance sheet and cash flow statement. And again, as I said earlier, just want to make sure you have an understanding of these, that you can explain a simple income statement, balance sheet, and cash flow statement. So the first thing I want to cover when we're talking about financial statements is publicly traded companies. So we have various kind of companies. If you own your own company, it's a private company. You don't need to generate any income for any income statements or balance sheets for anybody if you don't want to. It's always a great idea to do that, because if you wanted to get an additional investor, they would want to see your income statements and your balance sheet, but you don't need to do it. But if you're a public company, the Securities and Exchange Commission requires that you file reports periodically per GAAP practices. So we talked about GAAP in the last presentation. What we do here is, what is a publicly traded company? It's a company like Apple, Chevron. You can get your hands on. You can buy the stock if you want to. You can go to the NASDAQ or maybe the New York Stock Exchange and purchase the stock. And the idea is that there's a common form of reporting various information so that investors can make informed decisions. Now, if you're looking at a publicly traded company, how do you get this information? I'm actually going to take you through the steps to do it, because part of the homework assignment is to download this information for a company of your choice and to pull some of the numbers out of these reports. So the first step is to go to the Securities Exchange website, and that's sec.gov. So let's do that. And there's a electronic reporting system called EDGAR in sec.gov. So let's go to the Securities and Exchange Commission's website. So I've already brought it up here. So you go to sec.gov, and then what you want to do is you want to go to Filings. And under Filings, you want to go to Company Filing Search. Click on that, and then you go into this area right here, and you click on, you can either put in the stock ticker symbol or the stock name. So Apple's ticker symbol, Apple's ticker symbol is AAPL, so you could enter AAPL or Apple and click on that. And so what this brings up is the various reports that you can find. And there's 8K reports. 8Ks are information that's important to the company that has to be released. So for example, back in August, Apple announced some board of director members that were leaving and new board of directors appointed, and that required an 8K filing. These can get filed often, 3, 4, 10 times a month, depending upon what's going on with the company. And then there's the ones that we're most interested in are the financial reports, and those are the 10K reports, which are annual reports, and the 10Q reports, which are quarterly reports. So I'm going to click on that, and you can see that in October of last year, Apple filed its 10K for the fiscal year ending September 25th. So Apple's year does not go from January 1st to December 31st, I'm sorry. It goes from September 26th through September 25th. And there's no law requiring specific dates for the fiscal year. And so you can, like most companies do, a calendar year. We're not going to look at the quarterly reports. There's no reason why we can't look at the quarterly reports, but we're going to look at the annual report. Now, if I click on this line right here, I'm actually going to get the 10K document. Now, what I want to do is I want to actually get just the reports here. So I don't want to get the 10K document. I'm going to click on filing. So click on open filing, and there's all sorts of information here. Now, you might be inclined to click on 10K or right here, this document. If you did that, you still would not get something that you could download in Excel form. So we're going to click on interactive data. And then, so what we've done is we found Apple, we're into its 10K, and now we're into the interactive data, and we're going to click on View Excel Document. And what that does for us is we get our financial reports. And we can look at these in Excel. My Excel is going a little slower than normal right now. And there's all sorts of tabs down here. We're only interested in 3 tabs. So what Apple calls their statement of profits and losses is actually their Apple calls consolidated statements of operations. And like I said, different companies call them different things. But the bottom line is you're going to start with sales and you're going to get to net income. And that is typically going to have the consolidated statement of operations. That's going to be your earnings statement. Now, if we go along these tabs along the bottom, we've got the balance sheet. And that's what we're looking for here, the consolidated balance sheet. We have current assets. We've got non-current assets like property, plant, and equipment. And we have total assets, 351, I believe it's $1 billion. But, and then we look at our liabilities and shareholders' equity, and our liabilities and shareholders' equity equals the same 351. So this is our balance sheet. And then we have consolidated statement of shareholders' equity, which is not the cash flow statement. This is the consolidated statement of cash flows. And so this will tell you information which I'm going to describe in a second back in the presentation. But what I'm trying to show you here is that when you get to your homework assignment, this is where you go. This is the way you get your information and pull it from the SEC website. Close this out. Let me go back to our presentation here. And so what we want to get is that Excel spreadsheet, and then you can tinker with it and manipulate it all you want. So let's talk about the income statement and the profit and loss statement, the earnings statement. Those words are all used interchangeably. And what we start off with is it tells you what you've done over a period of time. So for that 10K for Apple, it's going to be for the prior 12 months. The 10Qs will be for the prior 3 months. Each quarterly report is for 3 months. And so we have revenue, which is basically sales. This is not income, it's sales. Cost of goods sold, direct cost material and labor that are necessary to manufacture a product. And next week I'm going to talk about how we calculate direct cost. It's much more applicable to engineers. And then gross profit is the revenue minus cost of goods sold. It's often called gross margin. You can express it as a ratio. So it's revenue minus cost of goods sold over revenue. That's your gross margin percentage. And basically it's saying what the money you have left over to cover non-cost of goods sold expenses. And those things might be your legal expenses, your HR, your advertising and marketing. Those are not direct costs. And so investors look at gross profit. When the startup company that I'm working with, I have a line item that I show year by year what the gross profit of the company is. It's an important item for companies. Now you have things like operating expenses. These are costs not related to the direct production of goods and services. So payroll, rent, utilities, I was talking about those earlier. And then you have operating income, or EBIT. And that's earnings before interest and taxes. So you pull out your operating expenses. Sometimes they throw at EBITDA, put a D on there, earnings before interest, taxes, and depreciation. We haven't talked about depreciation. I'll cover that later on in the quarter. And we have net income, which is operating income. I'm sorry, didn't mean to hit that. Operating income minus taxes. And it's going to, this EBIT is, if you have depreciation, it would be included in here as well. So let's look at the company. We'll look at Chevron. And Chevron, this is pulled off of Edgar. It's for the 3 years, 2019, 18, and 17. So it's somewhat dated, obviously. It's got 2 potential more years included here. And we have sales, and this can be typical of any earnings statement or any income statement. There's going to be other junk in there, and you're going to have to distill it out to look for what's important. But what we have, other things in there, income from equity affiliates. That means they may have partial ownership in another company, and those, so let's say the other company made $100 and Chevron owned 10% of them, then $10 would be included in this number right here under income from equity affiliates. Other income. What could be other income? Well, if they have excess cash, they may stick it in a bank account and it may have interest included in it. And then they have costs. And primarily the costs are Chevron refines crude oil into gasoline and diesel and sells gasoline and diesel. And so their primary cost here is they're purchasing crude oil and other products. And then they have other expenses. And probably these operating expenses are going to be, sorry about this, it's going to include, for Chevron, it's probably going to include material and labor required to refine the product, because it's not spelled out here. It's probably consolidated here. And then there's also going to be some of their other operating expenses like building and others. So Chevron's not as easy to put together. But I think the point here is if you look at the $100 million or $100 billion, I'm sorry, versus the $146 billion, it's the order of magnitude. So those are the most important numbers in the income statement. And then we'll talk about depreciation and depletion. That's basically how they recover their investments. And we'll talk about it later, but that's included um, um, in the deduction from income. Now, there's another interesting item here, interest on debt. This company is doing $150 billion in sales, 146. They have very little interest. Now, $798 million of interest may seem like a lot, but if you start to proportion it out, it's very little. And then you go down, they have total costs of $140 million, and then they have taxes, and then net income. And that's what we're after here, is net income. And so if you look at this, in 2019, Chevron had $146 billion in sales and just under $3 billion in net income. And there's other junk in here, but this non-controlling interest, but this is what's attributable to Chevron. The prior year, they had $166 billion in sales and almost $15 billion. So the year before that, $142 billion in sales and $9 billion in income. So if I'm looking at these numbers, I'm going to be looking at, well, what was the big change from year to year? Why do they have less sales in 2017 than they did in 2019, but almost 3 times the income? And you can look at this, well, the total costs are a lot higher. You can tie this back significantly to depreciation, which we need to explain, which is writing off some of the assets, and their cost of purchasing crude oil is less. So the snapshot by itself, I guess is what I'm getting at, is not as important as explaining why and understanding why things change from period to period. And then what is typically looked at is, if you're a shareholder, you want to know how much the income is per share. So this is your income per share is gone from $5 a share to $8 a share, down to $1.50 a share. That's important to you as a stockholder because theoretically you're entitled to all of that if you want. And Chevron pays out dividends. They pay it out of this amount. Now, diluted means there's options outstanding, and if all the options were exercised, this is what would have happened to the per share. So the income statement, it's a very important item. It's going to be different for every company. If you go through these different categories, this one is tuned for an energy company. Apple's is going to be completely different. The concept here is you understand the large items and how they change from period to period. Now, another thing you can do is distill this thing down. So here is the same thing. I basically said my cost of goods sold was this line item right here. I consolidated down my to net ordinary income, put the big ticket items like I showed in the prior example, and came down to the net income levels. I think this is a good way to do things for your own understanding with your company. Don't try to go through 15 different items here and explain them. Distill it down to something that makes sense. So let's look at a question here. We have a company, they have net income of $150. They pay $50 in taxes and $100 in operating expenses. What is their gross profit? So we know this is a given right here. We want to find the question mark. So we can use these formulas to back into gross profit of $300. Now, if we know that a company's earnings before interest and taxes is $700 and they pay $500 in operating expenses, and if we know their cost of goods sold, what is the company's revenue? So this is what's given. We can back into the gross profit, and then we can back into the revenue. Same company, if I tell you what their net income was, what are their taxes and interest? $150. So that's the income statement. Let's look at the balance sheet. The balance sheet is the picture of a company at a given point in time. So the income statement tells you how the company has done over a certain period of time, a quarter or a year. Balance sheet is the picture at the end of that period. So basically, the assets are what you own, the liabilities are what you owe, and the owner's equity is what you own, what's left over. So the assets are what is owned by the company, liabilities is what the company owes, the owner's equity is what the owners really have. So this is our fundamental equation, accounting equation, assets equals liabilities plus owner's equity. And assets are listed from most liquid to least liquid. And what liquid means is you can turn it into cash very quickly. So current assets are things like cash. It's already cash. Accounts receivables tends to be things that you sold that you expect to get payments on relatively quickly. Now, relatively quickly probably means within 30 to 60 days. From an accounting perspective, it means less than 1 year. And then inventory is things like products that you've made that you can turn into cash quickly. And then similarly, liabilities are things that you owe, accounts payable. If you owe salaries and stuff that are going to be paid, it's like an accounts payable. Those are the current assets. Long-term assets are things like obviously land, buildings, equipment, machinery. And long-term liabilities, let's not talk about deferred taxes. That's an accounting term that is like debt, but long-term debt. A pension plan, it's a retirement plan. If you owe a bunch of retirees money, that's a long-term liability. So that's what those are on a balance sheet. So there's different categories of assets and liabilities: short-term assets, long-term assets, short-term liabilities, long-term liabilities. You're going to have to look at this, download this and see this, but this basically puts together the balance sheet for Chevron. So we have our cash, time deposits or money in the bank, marketable securities, or if they've bought a certificate of deposit. And so they have an accounts receivable. Then they have all sorts of inventories: crude oil, chemical, materials and supply, total inventories. And then they have total current assets of 28 billion. And then they have long-term receivables. And honestly, I'm not sure what a long-term receivables are, but it would be money that's owed to you by a purchaser that's longer than 1 year. And that's very unusual. I think the most important thing here is we have net property, plant, and equipment. It's $150 billion. So we have property, plant, and equipment of $327 billion. We've got accumulated depreciation, which is deducted from that, of 176. So the net amount is $150 million. And then we've got other junk in here, deferred charges, goodwill, assets that are going to be sold. Total assets of $237 billion, of which 176 billion, I'm sorry, 150 billion, so about 60% are property, plant, and equipment. Then if we look at the liabilities, we've got the short-term debt. Short-term debt is debt that's due within less than 1 year. Accounts payable. So we got current liabilities of about $26 billion. Long-term debt of, looks like about $24 billion. That's not very much. We've got a company that's worth $237 billion, and they've got debt of $24 billion. About 10% of their assets are financed by debt. That's a very low number. Total liabilities of $92 billion. So my takeaway from this is that their total assets are $237 billion. They've got total liabilities of $92 billion. So they've got about $140 billion, and I'm around doing this in my head, of owner's equity. And you can see it's $145 billion. That's what the stockholders own. So if Chevron Company, if they paid off everything that was owed, or if they sold off all the assets at their book values and paid off all the liabilities, they would have $145 billion left. Now, what's important here is these numbers shouldn't change very much from year to year. And what does very much mean? Well, I'm looking at this number, and my total assets from 2018 to 2019 have dropped by about $16 billion. In my mind, that's a fairly large amount to drop. And so if I'm looking at this company, I'd want to look at this and I'd say, well, why is it dropping? Now, Chevron's, $250 billion, $240 billion company. I'm not real concerned about them going bankrupt. But if this were to happen every year, 253, 237, 220, I'd wonder what's going on in the business, and is it something I need to be concerned about? Now we can, again, condense the balance sheet, and current assets have dropped a bunch. Fixed assets have dropped a bunch. Maybe they had a big asset sale. They sold a bunch of, that's $20 billion. That's a lot. This number, other assets, that's about 20%. This is about 20% here. That's a big number. Most companies aren't going to have other assets. That other assets are things other than current and fixed assets. It's another category. It's a catch-all. But most companies aren't going to have numbers that are 20% of their total assets. So, but when you're looking at a balance sheet, you kind of want to distill it down into this type of a thing here, unless you're an investment analyst and you want to get into all the gory details. And then you can do the same thing on the right-hand side of the equality, where you have the liabilities and the equity, and you can kind of look and see what's going on here. But the takeaway here is the balance sheet is shrinking a little bit. Right, it's going from 254 to 237. Generally, that's not a good sign. If that's going on all the time, you wonder what's going on in the industry. I'm embarrassed to say this, but I don't remember what oil prices did in 2019. My instincts are they probably dropped a lot, and that's what happened here. Now, the cash flow statement is derived from the earnings statement. And the cash flow statement says, what did we, how much cash did we generate and what did we do with it? And we have cash flow from operations, and that's the most important thing. And so cash flow from operations is what you did from your ongoing business operations. And then we have cash flow from investing. When you generate cash, you can do two things with it. You can either return it to shareholders in the form of dividends, or you can reinvest it in the company. So, or I guess theoretically you can pay off debt with it. So this is the idea here, is that we've got three categories. We've got basic operations, we can invest back in the company, and we have financing. So what we have here is Chevron, and every company is going to do this slightly differently, but it starts off with the net income, and then they add back all sorts of junk. And you don't want to be an accountant, but it is typically depreciation is added back. And that gives you your cash provided by operating activities. So if you look at this, they made about $3 billion. Their depreciation was 29, so you add it back, it's 32. There's other junk in here. So they basically had $27 billion available to spend. And then if you look at what they did with it, they spent $14 billion on capital expenditure. So they put $14 billion back into the company. And then there's other junk going on here. There's little details here. But then they borrowed an additional $3 billion. They paid off $3 billion in debt. They paid $9 billion in dividends. So if you net all of this up, their cash changed, and this is what your most important thing is how much did cash change from year to year. So their cash changed by $3.5 billion. That's what we're getting at here. So we started off with $10 billion. We took $3.5 billion out, so we've got $7 billion left. This $10 billion is what we ended up with here. And there's a lot of details in here. And honestly, I have a lot of this detail in what I'm doing with the startup company, the sustainability company. But what you're looking at is I have net income, I add back depreciation, that gives me the cash that is available to the company. And I either spent it on investments or I paid it out in dividends. And generally that's what it is, and then there's a lot of little detail. Now, Chevron is a major company. They have a lot more line items in here, but that's what's going on with the cash flow statement. So part of the homework assignment, and I'm actually going to put this on Canvas as an explicit homework assignment, is I want you to go to the you want you to print off the financial statements for the company of your choice. As I've taken you through the example, put it into an Excel spreadsheet, income statement, balance sheet, cash flow statement, and then save that. Now, typically there's going to be 2 to 3 years of information in each one of those statements. That's all you're after. I don't want you to do more than download the one spreadsheet like I did. You don't need to download multiple spreadsheets. So that's what I want you to do. And then I'm going to take you through some ratio analysis in the next part of this lesson, which is going to be under a different YouTube video. And I want you to do some manipulations with the data from these three statements.